I wish someone taught me this about investing before I started. You save some money. Maybe it's $500. Maybe it's $5,000. And now you're sitting there thinking, okay, what do I actually do with this? You open your phone, you type how to invest, and suddenly you're drowning. Hedge funds, options trading, ETFs, crypto, bonds. Everyone's got an opinion and nobody's talking in plain language. Here's what I wish someone had told me from day one. Investing is not complicated. It only feels that way because nobody explains it simply. So today, that's exactly what we're going to do. And by the end of this video, you'll know more about investing than most adults walking around right now. Let's get into it. Before we talk about how to invest, let's talk about why you actually have to. And I want you to think about this honestly. Do you have money sitting in a savings account right now? If yes, great. That's a smart habit. But here's the part most people don't realize. That money is quietly shrinking. We talked about inflation in our very first video. If you haven't watched it, go check it out after this. But the short version is this. Prices go up by around 3% every single year. Your savings account pays you maybe 0.5%, sometimes less. So if inflation is eating 3% and your bank is giving you 0.5%, you are losing 2.5% of your money's value every single year. Not because you spent it, not because someone took it, just because you left it sitting there. Think about it this way. $100 today buys you less than $100 bought 10 years ago. And 10 years from now? Even less. So here's the question I want you to sit with. If doing nothing means losing money slowly, what's the smarter move? That's exactly what investing is. It's the answer to that question. Now, a lot of people make investing sound like this mysterious world that only rich people understand. But honestly, the basics are really simple. There are three main places people put their money to grow it: stocks, bonds, and real estate. Let's go through each one quickly. Stocks. When you buy a stock, you are buying a tiny piece of a real company. If that company grows and does well, your piece becomes worth more. If it shrinks, your piece loses value. Simple as that. Stocks have historically returned around 10% per year on average. And yes, they go up and down, but over the long run, they go up. Now here's a question a lot of beginners ask. If stocks can go down, aren't they risky? Yes, in the short term, they are. But here's the thing. The risk shrinks dramatically the longer you stay invested. The stock market has never failed to recover in the long run, not once. Next, bonds. A bond is basically a loan you give to a government or a company. They pay you back with interest over time. Bonds are more stable than stocks, but they grow slower. Think of them as the calm, reliable friend. Not the most exciting, but dependable. And then there's real estate. Buying property, renting it out, watching it grow in value over time. Real estate is powerful because of something called leverage. You can control a large asset with a smaller amount of your own money. But it also comes with responsibility. Tenants, maintenance, mortgages. Now here's what I want you to remember from this section. You don't have to pick just one. The smartest investors use a mix of all three. But as a beginner, you only need to focus on one place to start. And that's exactly what the next section is about. All right, so you understand what stocks and bonds are. But how do you actually start without picking the wrong company and losing everything? Here's the honest answer. You don't pick individual companies. Not when you're starting out. Instead, you invest in something called an index fund. Think of it like this. Instead of betting on one player to win the game, you buy a little piece of the entire team. An index fund like the S&P 500 gives you a tiny slice of the 500 biggest companies in America: Apple, Google, Amazon, Microsoft, all of them. In one simple investment. If the economy grows, your money grows with it. If one company fails, the other 499 carry you forward. That's the beauty of it. And here's what makes this even better. The fees are tiny. You don't need a financial advisor. You don't need to check it every day. You literally set it up and let it grow. We talked about compound interest in our last video. Remember how money growing on top of money creates an unstoppable snowball effect? That's exactly what happens here. An index fund combined with compound interest is one of the most powerful wealth-building tools in the world. And it's available to almost anyone. So let me ask you something. If all of this is this simple, why don't more people do it? That's actually the most important part of today's video. And it's coming up right now. Here's where things get real. Because knowing what to do is one thing. Actually doing it is where most people fall apart. And they fall apart because of three very common mistakes. Mistake number 1, waiting until you have enough money to start. I hear this all the time. I'll invest when I have more saved up. But here's the thing. There's no magic number. You can start with $50. Seriously. Most platforms today have zero minimum investment requirements. Every single day you wait, you're leaving compound interest on the table. Start small. Start now. Adjust later. Mistake number 2. Panic selling. The market goes down. You open your app, you see red everywhere, and your brain says, "Get out now before it gets worse." And this is where most people destroy their own returns. Because the market goes down. That's normal. But it always comes back up. The people who lose money are not the ones who stayed in. They're the ones who panicked and sold at the bottom. Imagine if you'd panic sold all your stocks in 2020 when the market crashed. By the end of that same year, the market had fully recovered. Anyone who stayed in was fine. Anyone who panicked lost. Mistake number 3. Picking individual stocks before you understand the basics. I know it's tempting. You see a company you like and you think, this is going to the moon. But picking individual stocks without research is not investing. It's gambling. And the data is pretty brutal here. Most individual stock pickers lose to a basic index fund over 10 years. Even professional fund managers. So save yourself the stress. Start with index funds. Build your foundation. Once you understand the game, then you can experiment. Okay, let's bring it all together. Investing is not for rich people. It's not complicated. And you don't need to understand everything before you start. You just need 3 things. Start early, stay consistent, don't panic. That's it. That's the whole secret that took people decades to figure out. The biggest enemy of your financial future is not the market. It's not bad stocks. It's not even inflation. It's waiting. It's the money sitting in an account earning nothing while the clock ticks. You know what I want to ask you? Drop a comment right now. What's stopping you from starting? Seriously. I read every comment and I want to know where people actually get stuck. Let's talk about it. And if this video helped you see investing differently, share it with one person you know who's been putting this off. Because honestly, this is the kind of thing people wish someone told them 10 years ago. Now, next up, we're going to go deeper. Real estate versus stocks. Which one actually wins over 20 years? We ran the numbers, and the answer might surprise you. That one's coming soon, so make sure you're subscribed so you don't miss it. Thanks for watching. See you in the next one.